Every night, nearly 700 million people go to bed hungry, not because the world doesn't produce enough food, but because economics decides who can afford it. Poverty is more than just empty pockets. It's about limited choices, missed opportunities, and a cycle that's hard to break. Welcome back to the Learning Studio, where economics is more than numbers. It's about people. Today's topic, part of our modern economic challenges, will explain the economic causes of poverty, how poverty traps are formed, and the policy measures that can change the story. You can find our full economics playlist linked in the description. What is poverty? Economists define poverty as a situation where an individual's income and resources are too low to meet basic needs such as food, shelter, clothing, education, and healthcare. Two main types. One, absolute poverty, living below a set income threshold, often measured by the World Bank's $2.15 day standard. Two, relative poverty, being poor compared to the average standard of living in a society. Economic causes of poverty. 1. Unemployment and underemployment. No job or jobs that pay too little to cover basic needs. 2. Low productivity. Lack of access to technology, training, or capital reduces earning potential. 3. Inequality. Wealth concentrated in a few hands limits opportunities for others. 4. Inflation. Rising prices erode the value of incomes, hitting the poor hardest. 5. Economic shocks. Natural disasters, pandemics, or conflicts that destroy livelihoods. Example, the 2008 global financial crisis pushed millions back into poverty due to job losses and reduced incomes. The poverty trap. Once in poverty, it's often hard to escape. No money, no education, low-paying jobs, continued poverty. This cycle can last for generations without intervention. Policy measures to reduce poverty. 1. Economic growth with inclusion. Growth that creates jobs for all, not just the wealthy. 2. Education and skill development, equipping people for higher-paying jobs. 3. Social safety nets. Unemployment benefits, food subsidies, and direct cash transfers. 4. Progressive taxation, taxing higher incomes more to fund public services. 5. Microfinance and access to credit, helping small entrepreneurs start businesses. 6. Price stability policies, controlling inflation to protect purchasing power. Case study, Bangladesh's microcredit programs, pioneered by the Grameen Bank, lifted millions out of poverty by funding small businesses for the poor. Famous quote, "Poverty is the worst form of violence." Mahatma Gandhi. Why this matters? Poverty isn't just an individual problem, it's an economic problem that affects productivity, stability, and growth. Reducing it benefits the entire economy. Coming up next episode, Climate Economics and Sustainable Development. Subscribe, hit the bell, and explore the complete economics playlist in the description. This is the Learning Studio, making economics human, visual, and unforgettable.